All right, let's just jump right in. You've probably seen this happen, right? A company reports record profits, their sales are absolutely crushing it, everything looks perfect, and yet their stock price just stalls. Or even worse, it drops. It's this super frustrating puzzle for pretty much everyone, from investors to the CEOs themselves. So today, we're going to unpack exactly why that happens.
So yeah, that brings us to the big question we're tackling here. How can a great company, a company that's firing on all cylinders, a leader in its field, end up being a bad stock? It just doesn't feel right, does it? It's totally counterintuitive. Well, it turns out the answer has to do with this really powerful, kind of invisible force that most of us don't think about.
Okay, but before we can get to that answer, we've got to be on the same page about how we even measure success for an investor in the first place. And for, decades now, the gold standard, the one number that everyone watches from Wall Street analysts to the folks in the boardroom, is something called total shareholder return.
So what is total shareholder return, or TSR? It's actually pretty simple. It's just the increase in the share price plus any dividends you get paid. So let's say you buy a stock for $100. It goes up to 110, and on top of that, it pays you a $2 dividend. Your TSR is 12%. Easy, right? It's a really clean way to measure what actually ends up back in your pocket.
And, that's exactly why it got so popular. The logic seems totally bulletproof, right? If you tie a CEO's bonus to TSR, well, they're going to do everything they can to make the shareholders rich. It seems like the perfect way to align everyone's interests. On paper, it's a fantastic idea.
But here's where it gets tricky. Does a good TSR number over a year, or maybe two, really tell you that the management team is doing a great job? Does it reflect the actual performance of the business? Well, as we're about to find out, TSR can be massively swayed by something completely different, and that something is expectations.
And that brings us right to the heart of what we're talking about today. The source material for this has a perfect name for it. They call it the expectations treadmill. And it's just a brilliant metaphor for this trap that so many otherwise successful companies fall right into.
To really get our heads around this, let's imagine a CEO. We'll call her Terry Turnaround. Now, Terry's story is fictional, but it's based on the real experiences of a ton of CEOs. She's just taken the helm of this company that's been, struggling. Because it's been doing so poorly, the market expects basically nothing from it. The bar is on the floor.
So in her first couple of years, Terry works absolute magic. Performance gets way better. And because nobody, and I mean nobody, saw this coming, the stock just takes off. It rises twice as fast as its peers. Fast forward to year 4. The company is now a star player, a real industry leader. And the stock, it's rocketing up at 4 times the average. But then, something weird happens. In years 5 and 6, the company is still doing great. Just absolutely brilliant performance. But the stock is just, meh. It's just doing average. What in the world happened?
Well, here's the thing. Terry is still a fantastic CEO, and she's still running a fantastic company. The problem is, the market isn't surprised anymore. That incredible performance is now the baseline. It's the new normal. Wall Street has already priced it in. So for the stock to get another one of those huge jumps, Terry can't just be great. She has to be even better than the amazing performance that everyone now takes for granted.
And that right there is the trap. Terry is basically running faster and faster, but in terms of stock returns, she's just staying in the same place. This is what the source material so perfectly calls the expectations treadmill.
Okay, so that story with Terry is a great way to picture it, but let's look at how this plays out in the real world with real companies. We're going to dive into this really fascinating case study that compares 2 totally different food companies over a few years, from 2013 to 2017.
So, in one corner, you've got Tyson Foods. You know them. A massive $40 billion giant. And in the other corner, we have J&J Snack Foods. They're a lot smaller, just over $1 billion in revenue. And they make things like ices and Auntie Anne's pretzels. So you've got this huge behemoth versus a much smaller niche player.
Okay, now let's actually look at the numbers, because this is where the puzzle really starts to come together. First up, revenue growth. J&J, the little guy, grew at 6% a year. That's twice as fast as Tyson's 3%. Okay, now let's look at profitability, what we call return on invested capital, or ROIC. J&J's was 24%, which is way ahead of Tyson's 19%. So let's be clear, J&J grew faster and was more profitable. But now, look at that last number, total shareholder return. Tyson's annual return was a whopping 27%, nearly double J&J's 14%. And there's the puzzle, right there in a nutshell. I mean, if you're just looking at the fundamentals of the business, J&J looks like the clear winner. They're performing better. But if you were an investor, you made a ton more money owning Tyson stock. So, who actually did the better job? It's confusing, right?
To figure this out, we can't just stop at that final TSR number. We have to look deeper. We need a tool that lets us pop the hood and see what's really going on inside. And the source material recommends this really powerful technique. You can actually decompose TSR, break it down into its core drivers to see where that return really came from.
I know this chart might look a little complicated at first glance, but the idea is actually pretty simple. Instead of just looking at TSR as this one single number, we can break it apart into its main ingredients. Things like how much the business actually grew, how their profit margins changed, and this is the really important part, how the market's expectations shifted. And here we go. This table right here, this is the smoking gun. This is what solves the entire puzzle. Don't get bogged down in every single number. Just look over at that far right column, the final TSR as we already talked about. 27% for Tyson, 14% for J&J. Now we're finally going to see why.
All right, let's focus on what really matters here. Look at J&J. Their return came from exactly what you'd want to see. Good old-fashioned revenue growth. Solid. But now look at Tyson. Their growth was actually so expensive it cost so much to achieve that it negatively impacted their shareholder return. So where did that huge 27% come from? Well, almost all of it, a staggering 22 percentage points, came from jacking up their profit margins, plus a little boost from taking on more debt. See, they weren't a better growth company than J&J. They were just absolutely smashing the market's super low expectations for their profits.
So there you have it. The mystery is solved. It's not that Tyson was a fundamentally better-run company than J&J. Not at all. It's just that the market expected next to nothing from Tyson, and when they completely blew past those low expectations, the stock had to reprice itself upwards, creating that huge return for investors. J&J, on the other hand, everyone already expected them to be great.
Okay, so what does this all mean? What's the big takeaway for managers, for leaders, for investors? How do you keep from getting stuck on this treadmill yourself? Or if you're already on it, how do you deal with it?
Well, the source material is super clear on this. First off, stop trying to manage your company by staring at the stock ticker all day. Forget about short-term TSR. Instead, focus on the real, long-term drivers of value that you can actually control. Things like profitable growth. Second, you have to be realistic. You've got to understand what the market already expects from you, what's already priced in. And finally, for any boards out there, maybe it's time to align executive compensation with long-term, fundamental business results, not just the wild up and down swings of the stock price.
And really, this all boils down to one of the most important lessons in investing, one that this whole expectations treadmill idea explains perfectly. And it's this: a great company is not always a great stock. And sometimes a not-so-great company can be a fantastic stock, at least for a while. The difference is all about the price you pay, and more importantly, the expectations that are baked into that price.
Which kind of leaves us with one last really tough question. Think about a company like J&J Snack Foods, or any business that's already a high performer with really high expectations. What do you do then? I mean, if you're already on that treadmill and it's going super fast, is there any way to get off? Or is your only option to just keep trying to run faster and faster?